Tag.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the Real Investment Show, day 2 of Trade War. That is the title for today, of course. Shortest trade wars in history occurred yesterday. Again, yesterday morning, we said, importantly, hey, look, these things, are temporary at this moment. There's going to be a lot of debates going on, a lot of headlines. So our advice yesterday was to basically just go away, leave the markets alone, turn everything off. Come back at the end of the day. That was very good advice. The market opened at the worst level of the day, first thing in the morning. In about 2 hours, the market recovered sharply as Mexico agreed to basically send 10,000 troops to the border, assist Trump in curtailing the cartels, the illegal flow of drugs and immigration into the United States, which was all Trump wanted with these negotiations. So with that agreement from them, now again, we're waiting action, right? It's easy to say stuff, but actually putting stuff into action. But because of that agreement, they delayed the tariffs on Mexico for 30 days. Then later in the afternoon, it was Justin Trudeau's turn to face off with Donald Trump, who immediately took a knee and said, well, we're going to send 10,000 troops to the border. We're going to assist. We're going to announce an illegal drug czar. We're going to put $1.2 billion in funding to these programs. And so with that, their tariffs were also delayed by 30 days. Again, waiting to see actual action. Easy to say stuff, but what Trump wants to see is action. But this is what we talked about yesterday, and we actually have a video that we posted on the website, realinvestmentadvice.com. It's also on our YouTube channel right there pinned at the top. which is basically kind of went through our analysis yesterday. If you didn't get a chance to see that, go back and watch that. That's right there at the top of the YouTube channel. I also posted today's article on the website, which I did a very quick update. I told you yesterday that I'd write a quick update on the markets based on, kind of what happened because of what was going on. That's posted this morning as well on the website. It goes through kind of the short-term technicals, kind of the weekly technical analysis of the markets, and kind of the outlook from here. But anyway, all those kind of details are in there. So today, though, is China's turn. So China this morning announced some retaliatory tariffs. We have a 10% tariff on China right now. China announced some retaliatory tariffs. Again, these are not enacted. They're just basically announced retaliatory tariffs because they haven't negotiated yet. So President Xi and President Trump have not gotten together to negotiate that deal yet. That's still coming, but that is weighing on the market. Very little this morning. Futures are down 5-6 points on the S&P. Much better than what we saw yesterday morning. So again, markets are kind of starting to come into kind of terms with what's going on. Now, having said all that, this is just the process of what's going on. If we go back to 2017, 2018, 2019 in particular, remember we were having trade wars with China before. Despite all of the headlines, and this is why I was telling you yesterday, just turn off the media. The stuff that's mostly in the headlines is wrong. It's not how the markets are working. Back in 2017, 2018, 2019, we were having tit-for-tat trade wars with China. Yes, there was some market volatility, just like we saw, but those volatility bouts were also buying opportunities for the markets. Markets would continue to rise all through 2019 as kind of we were heading into the COVID pandemic. But the trade wars were certainly causing those bouts of volatility, but yet when markets would decline on those announcements, those actually turned out to be decent buying opportunities. The other side of that was we had no inflation either. Inflation didn't go running off to the moon. Again, a lot of these headlines are saying, oh, tariffs are so inflationary. They're not. As we discussed yesterday, companies are the ones that pay that tariff. The ability to pass that tariff on to consumers where inflation will actually show up is very difficult to do. And again, that's why we didn't see it back in 2018, 2019. Likely that's not going to be the issue again as we go forward. So again, just be careful of headlines because they lead you to make emotionally bad decisions. And this is what we're talking about yesterday. If you looked at the headlines first thing yesterday morning and like, oh my gosh, start loading up your orders to sell stuff right there at the open, that was the worst sell of the day. And a lot of people got swept up into that because, again, the markets immediately started to recover from that open. So, again, most of the time, you're better off just kind of going away, let the markets do what they're going to do. So here's what you need to know before the bell this morning. I want to show you two charts on the S&P, just kind of give you an update to where we are. So again, despite all of these massively negative headlines over the last 2 weeks, money flows continue to be very positive here. Yes, this is, part of this cycle we're going through. Markets have gotten pretty overbought. So again, we're just kind of going through a corrective phase. We are very close to triggering a short-term sell signal. It's about halfway through a recovery, so there's not a lot of downside pressure here, but there is some. So again, we could see the markets come back here a bit, just, a bit more kind of working through this consolidation process after that we had this kind of big run, got to this kind of very overbought condition, just working through that process. So a consolidation, correctional process at this juncture is not surprising, but money flows remain positive. Also, again, we just went through we're going in the midst of earnings season, a bunch of earnings out this week, and then the buyback window opens up the following week. So again, as we kind of go through all of this, we're kind of setting up here for a bit, could be a bit of a challenging 2-3 weeks here. But again, we get the markets back to a more oversold condition. We're in a better position to kind of stage the next rally for the markets. So again, kind of the other side of this is just looking at the actual index itself. So if we take a look at kind of what's happened over the last couple of days, again, this was that really sharp down open yesterday morning. Big candle back to the upside, closed back above the 50-day and the 20-day moving average, just barely. We're going to be flirting with this today. The markets really kind of need to kind of get some muster later on this morning and rally back on above that 50-day moving average. That would keep all this support currently intact here. But again, we are very close to a sell signal and not really oversold yet. So there's a decent possibility that this market could fail at this resistance level, come down, retest this 100-day moving average, which would be about 58.60 on the index. That would not be outside the norm for the month of February anyway, which tends to be a little bit weaker towards the end of the month. So, kind of, again, just kind of going back through this analysis is that the markets have been in a big consolidation range. Now, as we talked about yesterday, for the last really 2 months, haven't really gone anywhere. Seen a lot of rotation within the markets. We've seen money rotate into mega caps, back into value stocks, back into mega caps, back into value stocks. So we've seen a lot of rotation and gyration here through the markets over the last few days, last few weeks, and still in that correctional consolidation process. If we can get the markets back to a more oversold condition, hold support here between 5,800 and say 5,900, somewhere in that range for the markets, that will set the markets up for a bit of a stronger rally. We're still in the seasonally strong period of the year. March, April, May tend to be decent months. So again, a bit of consolidation here through the month sets the market up here for a bit of a rally as we finish out the seasonally strong period of the year. So again, just be real careful with these headlines. We can't stress that enough. There's so much emotional tug right now in the markets because of concerns about the unknowns, right? The tariffs, the trade wars. We don't do a lot of historical research. We just kind of throw headlines out there to try to get clicks and views and those type of things, and that's all fine. But it really starts to drag at those emotional biases that we have as investors, want us to start making decisions. And again, so in today's article, I kind of gave you 5 rules to follow. When you feel the need, you must do something, like I've got to do something. A lot of times it's better not to do anything, but if you have to do something, small steps. And I give you some of those steps in today's article on the website, realinvestmentadvice.com. We'll take a quick break, we'll come back, pick up with John Penn. Lots of stuff to get into. We're going to talk about client questions that have been coming up all around this and more. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you thought retirement income was just stocks and bonds, let us help you understand how to rethink your approach. Our first Candid Coffee of 2025 has everything you wanted to know about income in retirement. Saturday, February 8th with Richard Rosso and Danny Ratliff. What else is there besides stocks and bonds? Is your retirement paycheck really diversified? Everything you wanted to know about income in retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show right now. John Penn joining this morning. John, how are you?
Good. Good morning. How are you?
I'm doing good.
Got my coffee. I'm ready. Lots of coffee.
Lots of coffee.
The last couple of days have been, actually the last 2 weeks have been pretty challenging between, last Monday,
Yeah.
we had DeepSeek, and you and I were on Tuesday talking about all the client concerns over DeepSeek. And then, of course, yesterday now we have this whole trade war issue. So lots of phone calls yesterday.
It's like, I do enjoy my weekends. Can we tell the folks just quit putting out all these headlines over the weekends? Can they at least wait till Monday morning?
Well, no, it's better over the weekend because it just lets everybody just...
It's like the pot simmers.
Exactly, all weekend. And
It just simmers and it boils, and then Monday morning it's like...
exactly.
But you brought in the last segment, you were talking a little bit about, the mark. It's like, it's what's the theme of the week, right? Last week it was DeepSeek. Yesterday it's the tariffs that went into place. And, as you were getting questions from clients around, hey, I'm nervous. Market volatility. I think investors right now are just very, very sensitive to what's in the headlines, and they're very emotional about this. And I really like the idea of, you got to tune out the media, unless it's us. Of course, listen to us, right?
Right.
But like yesterday, before the market opens, the media is all over. The Dow is down 600 points. The Dow is down 600 points. Okay, 600 points, but the Dow's at what, 44,000?
Right.
So from a percent standpoint, it was down about 1.35%.
But see, the numbers sound big because back in the day, right? I mean, back in the day, this is where I'm going to pull out my ancient, where my kids are convinced, that my first car I had to pedal with my feet.
We had stone tablets and chisels.
Correct. But look, in 1987, when the Dow was trading, a 600-point clip was a big thing.
That was a big thing then.
Right? Mm-hmm. Even really in 2008. Or in 2020, when we were dropping 1,000, 1,500 points a day, that was a thing.
Yeah.
Now it's a couple of percent because we've just elevated the market so far. But these numbers, they sound so large. It's like 600 points. And again, this is what I was talking a lot about yesterday, is that you're really better served just to go away, go fish, go golf, go do something, and just turn off all the headlines, because these headlines are just going to, urge you that you just, I've got to do something. I'm going to lose all this money this morning. Mm-hmm. But are you? And this is one of the things that John and I have talked about recently, and it's becoming a much more ingrained problem for individuals, which is they benchmark to this high watermark.
Yes.
Right? Oh my gosh, I'm down 1.5%, from the peak. Yeah, but you're up 3% for the year or whatever, right? So just... it's important to you've got to step back and put some things into perspective and not be so glued to, each hand of blackjack that you're playing, right?
Yeah, because just look at how you did last year. Look at your performance last year, and look where you and so many clients. Well, not really. I will say our clients have a really good perspective around this because we spend a lot of time talking through it, especially on the financial planning aspect of things. But there seems to be a tendency of folks out there to look at, okay, well, this is my balance as of December 31st of last year, and now that's their high water mark. Right. And any sort of movement downward from that, a 1% move, a 2% move, it's But go back and look where you were 3-4 years ago, and look how far you've come.
Right.
That is a much better gauge, and I think if you can just get away from the short-term hype and take a longer perspective with this, it'll just kind of help you take a deep breath, and where you just go, okay, market's down, 1% before the open, big deal. Right. I'm not going to let this affect me. Right? I'm not going to make a knee-jerk reaction to this.
Right.
Yeah.
And again, because what happened? What happened yesterday morning?
Yeah.
It was shocking, right? For the markets. You wake up and it's like, look, my day doesn't start out great when I get up and I open up my phone and just check the futures. Futures are down. I'm like, because I just know what the day's going to be, right? It's just not the way I want to start my day. And then so I'll go get in the shower, do my stuff, come down here and get ready to do the show. But, I much prefer a day where it's all green.
Of course. Oh, we all do.
That's much better.
Absolutely.
But this is just part of, this is part of the journey, right? Just part of the journey is markets are going to go up and down over time. And what we have to separate out is this a buying opportunity or not? That's the question that we're looking at. And we'll find out. It may be the buying opportunity right now, but as I was just saying a second ago with the kind of the technical setup, It looks like we're going to have a little bit more of this correction process going now for maybe another couple of weeks. Wouldn't be surprising. Get the markets pretty oversold, and then you can actually go, okay, now there's some opportunities out there. There's some stuff that's really, really oversold that I've been wanting to buy. A good example, just for us, right? Palantir got sold off like 20%, 22%. And we were like, we've been waiting for an opportunity to buy that stock. We've just been patient, waited, and we were actually able to add it to the portfolio. And it's doing great. Now, announced earnings last night. It was up like 20% last night on earnings. I don't know what it's doing this morning yet. But, those are things you want to look for. Look for these sell-offs as opportunities to put capital to work. Not look at these sell-offs as this is the beginning of the end.
Right. And I think that's what folks are. That's what I think investors out there have a feeling that that's what is in store for the market, or there's more of a concern around the big one now, because you go back and you look at 2023. 2023 was a pretty healthy year for the market, right? 2024 was a healthy year for the market. So this year in 2025, are we going to have another market of north of 20% returns?
I don't think so.
Right? Or, so I mean, even as we were going into last year, as we were getting into the end of 2024, getting into 2025, I mean, we were telling our clients, look, we wouldn't be surprised if 2025 was going to be a little bit more volatile. And here are the reasons why we think that. Right. But is there a big one coming around the corner? I think folks are just very, very, very hypersensitive to that right now.
Well, and again, it's because of it's all what's in the headlines, right? I mean, it's all these guys out there, making YouTubes or whatever. And it's like, oh, the big crash is coming. You better, be in cash or whatever the market's going to. Yeah, it's just, and those all sound great, right? I mean, they're great headlines. They certainly attract viewership. Here's a chart though I posted this morning on X. Deutsche Bank put this chart out this morning. I'm gonna steal it and I'm gonna duplicate it for an upcoming article because it's really good.
Love the honesty.
Hey, I got to get my ideas from somewhere. It's not like you're bringing any to the table.
I'm just going to check my coffee then.
Just teasing.
Whoo, zinger.
I actually have two charts here for you. So this is President Trump's first term. So he got elected in November of 2016, took office January the 20th of 2017. And this is a chart of the market and from 2017 through basically January of 2020. Now, of course, in 2020, we had the COVID crisis, right? So this doesn't show the COVID crisis. But what this shows you is all these dots on here are the different trade wars that we were having with China at the time. And there was, and this is one thing I said coming into this year, is I would expect a year of a lot more volatility, which is what we're seeing now. But those periods of volatility are often turned out to be very, very good buying opportunities. So we would have these trade war announcements. The markets would sell off. See that big dip right there? It looks like, oh my gosh, that's a huge crash. You look at this on a longer term chart, you can't even see that anymore. That was about an 19% decline. With the Fed was hiking rates at the same time we were having this trade war. And we had a fairly big dip. That bottom of that dip in December of 2018 is where the Fed reversed course and said, we're no longer hiking rates. And then they began cutting rates going into and starting in July of 2019. But the point is these were buying opportunities more often than they were selling opportunities. And that's really kind of the key here. Let me show you one other chart just to kind of bring this to a conclusion. This is the actual trade. Let me make this a little bit bigger for you, Brent. There you go. Got it? Okay. Sorry. I'll leave it alone. Okay, I'll leave it alone. But this is basically the tit for tat between the U.S. and China on tariffs. This is a chart of volatility. So this is realized volatility of the S&P 500. So when these, and again, if you overlay this with the actual stock markets, you'll see those declines that were happening in the stock market during these kind of announcements. But these pickups in volatility over these announcements were good buying opportunities for the markets, not selling opportunities. So, again, you have to navigate this to a degree and understand that there's going to be volatility, manage the risk in your portfolio, those type of things. There was also no inflation during this period, right? So all these headlines that are talking about, oh my gosh, there's going to be all this inflation from tariffs. again, as we talked about, there was no inflation during that period. Inflation remained right around 2%. And because corporations were having to basically absorb the tariff and they couldn't pass it on. Consumer choice, as we've talked about before, is an important driver of inflation. So again, the point, now, could things be different this time? Absolutely, right? But this is, other than 1915 to 1940, this is the only time in history we have tariffs to go back and look at and how markets responded to tariffs during the period. So this is our benchmark that we're looking at right now. Could this time be different? Absolutely. Things could certainly be different this time, and that's why we have to navigate, manage risk as we go.
Yep.
But again, we can look back at recent history and say, how did markets actually react to these things and what actually occurred? So again, the whole point of this, John, is just separate out these more bombacious headlines that are trying to, I don't know, I'm just making words up as I go. Bombastic. Is that better for you? How about disharmonious?
Now I really need to refill my coffee. Wow.
These bombastic headlines to get you triggered into doing something. And generally also remember, the one thing to look at, do these people actually manage any money, or are they just writing headlines for a media source? If they don't manage money, ask yourself the validity of what they're actually talking about. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
If you thought retirement income was just stocks and bonds, let us help you understand how to rethink your approach. Our first Candid Coffee of 2025 has everything you wanted to know about income in retirement. Saturday, February 8th with Richard Rosso and Danny Ratliff. What else is there besides stocks and bonds? Is your retirement paycheck really diversified? Everything you wanted to know about income in retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
One thing that the consumer confidence measures, is that correct if I say consumer confidence measures?
Measured squared.
How many measures can the consumer confidence measure? I don't know.
The Real Investment Show podcast.
Dr. Seuss.
The consumer confidence measures investor sentiment about stocks. That's the highest level on record.
Same show, your schedule.
It's amazing. And consumers are super confident about the stock market.
At realinvestmentadvice.com.
At the same time, they go, my life sucks economically, but the stock market, it's all good.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell reports and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So right now, futures on the S&P are basically flat. Nasdaq's up a smidge. So we'll kind of see how market kind of works out this morning. Again, got a little bit washed out yesterday, so a little bit of, kind of a little bit more of a follow through from yesterday's announcement. Again, and China's tariffs, by the way, are 10% versus 25%. And the retaliatory tariffs from China are very kind of targeted, specific. They're not broad. So again, they're not as impactful as what we were going to see from the 25% tariff on Canada and Mexico. So, it's a little bit of a different structure, and I think the markets are starting to try to see through that just a little bit. So, anyway, we covered a lot of that kind of Trump stuff, kind of tariff stuff in the first segment, but again, kind of some other things that we've been getting a lot of questions on, and I get this one a good bit, is on concentrated stock positions. One of the things that happens over time is that we, invest in a stock, and it does, and there's a lot of people out there, they maybe they work for a company. We saw this a lot, and right during the .com era, and this was a really good example of this. John was still in diapers at the time, but
I was still working with clients
in 1999. But 1999,
that is correct.
But 1999, 2000, a lot of people were getting hired by these .com companies. They didn't have any money, so they would just give them all stock options, and that's how they would get their compensation. They get a participation within the company, and so these companies were rapidly going public, and people would immediately become millionaires overnight. And we heard about the stories about secretaries at Microsoft had millions of dollars because of Microsoft stock, et cetera. And of course, that all went away very quickly during the .com crash because they had very concentrated positions. And one of the, of course, one of the, the most memorable stories of all this was Enron, where secretaries and the guy that cleaned the garage in the Enron building, they were millionaires. They had very menial jobs in a lot of cases, menial wages, but they were millionaires because they were taking all this Enron stock that they were being given by Enron, or they were just buying it heavily, and like their whole 401k plan was all invested in Enron because Enron was just going through the roof. And so where people are just making money hand over fist. And we were warning back then about, be careful with, company stock in particular. That should be no more than about 20% of your 401k plan. Because, again, regardless of the company, whether it's ExxonMobil or Enron or WorldCom or Apple, right? I mean, there's companies on both sides of the spectrum. WorldCom went belly up too, by the way. But you never know what's going to happen for certain, right? Things change, things happen, and you can lose a whole lot of money. So, over concentrating your wealth into one single position has real drawbacks if something goes wrong. Of course, if everything's great, having an over concentrated position is fantastic, right? So, if I have my entire portfolio in, NVIDIA 5 years ago, I've done fantastic, right? I've quintupled my money over the last 5-10 years. But there's a risk if something goes wrong, right? And so there's an accelerated risk with concentration in your portfolio. Now, there's ways to manage that, John.
There is, and I'll tell you, you're talking about Enron. I remember this like it was yesterday, and I routinely tell this story to folks that I visit with. Excuse me. that have a lot of concentrated stock, either that they bought on their own or they're getting it through employer. I mean, so back in the day with Enron, I was at Charles Schwab, and a gentleman walked in. I had never met him. It was just a Schwab client walked in, wanted to talk with somebody about their portfolio. Mm-hmm. And I was probably in my late 20s at the time. Diapers. And this gentleman sat down in my office, and he just put his hands on his face, and he just started to weep. And he was probably in his late 50s, not quite 60 yet, and he just had his hands in his face, just crying like a baby. He didn't even say a word. And so I just let him cry for a couple minutes, and I just finally said, what can I help you with? And he goes, I don't know what to do. I just lost all my money. It was all in Enron. It is gone. Luckily, he was still in his prime earning years, mm-hmm. and he could make up a significant amount of what he lost, right? What he was really upset about was he had invested his mom's money in 100% of her portfolio in Enron preferreds. Gone. All of it was gone. So now not only was he, taking care of himself, now he had to take care of mom, right? And as somebody that was relatively new in the industry, I sat there and I was like, well, nobody trained me for this. How are we going to talk about this, right? But it just sometimes when and I have this conversations a lot with folks who work for a company and they are getting their employer stock, and the employee is very entrenched with the values and that forward-looking vision of the company, where you are in the trenches on developing projects, working on new releases, and man, this is going to be great, and the market's going to love us, and we're going to have wonderful earnings per share, and this is going to drive our stock price higher, and this concentrated stock position that I have is going to just double and triple overnight. I hope it does. I really hope it does. But just as Lance and I were talking in the previous segment about headlines and how sensitive investors are, the harsh reality is you see as an employee, and you're earning that stock over time and you're working really hard, the market will view that differently than you. All the market really cares about is, are those shares continuing to go up? And if they don't, what will be a catalyst that will turn the market of buyers for that company into a market of sellers? And don't let the media, don't let the market take that away from you, right? Because it can happen. It can happen.
This really falls into a whole basket of other things that investors talk themselves into, like, oh, I just bought this company for the dividend, right? I hear this all the time. It's like, I own this company and I just own it for the dividend. It's paying me like a 10% dividend, so I own this company for the dividend. And I don't care what the stock price does. I just want the dividend. Well, we just saw a couple of companies just recently. Walgreens Boots Alliance is a good one. Basically, stock has been crushed. It's down 64% last year, so you've lost 64% of your money. But hey, you were still getting the dividend until about 2 weeks ago, because they eliminated the dividend. So now you're down 64% in your portfolio, and you have no dividend. So all these theses that, which are just rationalizations. Yes, the stock price is down. I'm still getting this dividend. You're losing principal, right? You're destroying your underlying principal. And that should be your one goal, regardless of whatever it is. I mean, one other thing, inheritances. I see this a lot too. Grandpa John invested in ExxonMobil. And he worked for ExxonMobil. Grandpa John's hypothetical, by the way, not my personal grandpa.
I was going to say, you were calling me a baby earlier. Now you're calling me a grandpa. Is there something I need to know? I'm not quite ready for that yet.
Yeah, exactly. It's coming. You and me both. It's coming. But Grandpa John, he worked for ExxonMobil back in the 30s, right, when it was just mobile back then, and was investing in company stock, and he would just put a little bit of his paycheck in it for years and years and years and years, all through the 30s, the 40s, the 50s, the 60s. He was just, dribbling away. And he accumulated this large number of shares of ExxonMobil stock. And when he passed away, he transferred it through the will to his heirs, right? And so he had one grandson that got all these shares of ExxonMobil. And so it's fantastic. Now, I'm using ExxonMobil. I'm going to give you a real life example. Fifth Third Bank. Client that I was working with at Fifth Third Bank had inherited a ton of Fifth Third Bank stock from her mother when she passed away. She would not sell it. During the financial crisis, that stock went from about $150 a share to $3. Lost all of it, basically, at that point. And she was distraught by herself. So it was just completely devastated by losing all this money that her mom had basically given to her. Inheritances are not about the stock. When you are, and I may have a different, John may have a different view on this, but this is my view, and feel free to disagree with me, John. That's completely okay. This is my view. I can have this view because I have nobody in my family that's ever going to inherit anything from. So I don't have any parents, grandparents, nothing out there. I will never have an inheritance, so I can have this view. It may be different for John, but we'll let him weigh in on this. But my view is this. The parent or the person or whoever it was that gave you the inheritance didn't give you the stock to be the steward of. They gave you the value, and they wanted that value to enrich your life. My suggestion is always when somebody comes to me and says, oh, I just inherited all this stock. Fantastic. Go sell it all today. Sell 100% of it today. They're like, why? Well, you have a step up in cost basis. So you can sell all that stock today at no capital gains. And so now you have that raw value of the stock in your portfolio, that value that they wanted you to have. And now you can go make some financial decisions about what to do with that money, how to invest it, how to diversify it, those type of things. But we get tied up in this emotional thing. It was like, this was grandpa's stock, or this was my mom's stock, and she loved this company, so I can't sell it. I'm just emotionally tied to this because it belonged to a relative. They don't care about the stock. They care about the value they gave you, and they want you to protect that value, not protect the stock.
Yeah, it's the wealth that they are giving to you, right? And here's what I tell folks all the time. The shares that are in your portfolio, guess what? Those shares don't know that you own them. Mm-hmm. There is no, it's property. That's what those stocks and bonds are. They are investments. They are security holdings. They don't have feelings. They don't know that you own them. So it's very easy as investors, as humans, we're wired that way to have some sort of sense of attachment or a sense of like belonging to that object that we just received from mom, dad, grandma, grandpa, right? Mm-hmm. So I'm with you. Yeah, especially with that step up to fair market value, you get that step up in cost basis in a non-IRA account. That's huge as far as diversifying away from that, and you've got a clean slate to then redeploy those assets based on what you need that money to do for you, right?
That's right. All right, quick break. We'll come back. Get ready to wrap up the show. A few highlights going into today. We'll cover those. Earnings announcements today as well. Important big ones coming up today. They'll also kind of move the market tomorrow. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you thought retirement income was just stocks and bonds, let us help you understand how to rethink your approach. Our first Candid Coffee of 2025 has everything you wanted to know about income in retirement. Saturday, February 8th with Richard Rosso and Danny Ratliff. What else is there besides stocks and bonds? Is your retirement paycheck really diversified? Everything you wanted to know about income in retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic cutting-edge cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. So, real quick, just to finish up on concentrated positions, it is okay to run a concentrated position if you know what you're doing and you know how to hedge it. So, if you know how to write calls, buy puts, hedge your risk, you can run big allocated positions. So, again, just we're talking in generality. Right? Most people, they just run concentrated positions raw, which means they just hold the position and they just kind of hope it goes up over time. And that's fine because generally that works. The risk you run is, again, an Enron or a Fifth Third Bank or some other thing, some other company that winds up taking a huge correction at some point. Cisco Systems is still on an inflation-adjusted basis is not back to where it was in 2000. So, there's risk to all these things, and you just have to, understand what that risk is. And again, this is why we talk about portfolio management. We talk about strategies, talk about diversification. This is for the average person that's just trying to build some wealth. And, you can take a big swing for a fence and it may work out great for you. And I'm so happy if it does. The point is, though, is that generally, as Murphy's Law always goes, is that when things fall apart, it's generally at the worst possible time. And you're in your 50s, you're, close to retirement. And again, look, I met with a ton of people in 2000, 2001, 2002 that were on the verge of retirement that are still no longer retired.
Yeah.
Right.
Well, and here's something else I noticed too when it comes not only to just concentrated stock positions, but just investing in general, but more so around the topic of concentrated stock positions where folks are acquiring stock and they have this nice big old chunk of stock in their portfolio, and let's say it's in a taxable account. Well, John, I don't want to sell because I don't want to pay the capital gains. I don't want to pay tax. Okay. So chances are a lot of these shares have been held for well over a year. They've been held onto for quite some time. So if you take some profits, if you trim, if you just start to move away from the position with some strategy, with a plan, chances are the gains that you're going to pay are long-term capital gain and not ordinary income. And depending upon what your income is, your long-term capital gains will be either 15% or 20% long-term capital gains taxes, right? So, but so many times, Lance, I hear, well, I don't want to sell, I don't want to pay the capital gains. There's got to be a way to avoid paying the capital gains. Well, great example as of late. Monday last week, DeepSeek comes out. What happened to NVIDIA? NVIDIA was down 17% like that.
Right.
So, I don't want to take capital gains. I don't want to take capital gains. I don't want to sell, take my capital gains. That's okay. The market will do it for you if you're not careful.
Right.
Quickly, right? So I guess in short, don't let as we say, don't let the tax tail wag your decision or wag the dog when it comes to managing that, right? And I'm not saying that you need to go in there if you have a big concentrated stock position. You don't have to go in there and sell the whole thing at once, but just have a strategy to say, okay, pre-plan it. Just like we plan with retirement planning, financial planning, we look at Roth conversion analysis, all these different strategies. Have a plan for how you're going to start reducing your concentrated stock position. Just know, okay, this is the amount that I'm going to trim, and this is what I know I'm going to pay in tax. And what's great about the custodians that you work with, or whether if it's a Fidelity or a Schwab or whomever, especially if those shares are in a regular brokerage account and you've been acquiring these shares over time, you can go in there and pinpoint the exact share lots that you want to sell, so that way you can better manage your gains, right?
Yep.
So again, don't let taxes be the sole reason. Well, I'm not going to sell. I'm not going to sell. I'm not going to sell. Well, don't get too cute with it, because the market will do it for you.
Right. Well, yeah, we talked about this before,
Yeah.
and I was just having a conversation with Adam Taggart last week and saying, look, you have two choices with the markets. If you treat the market like a casino, which is unfortunately what most investors are doing today, and when I would say most investors, I'm talking about particularly about the younger generation that's coming up now. Those have really entered the market the last 15 years. They just treat the market like a casino, and that's okay. The problem is that eventually the house always wins. And, a lot of this speculative leverage that's being taken on through, 0-day options and options trading. We just had a massive surge in call volume, single stock levered ETFs, leveraged ETFs, just a massive amount of leverage being put into the markets and people's and individuals' portfolios. That works great on the way up. Leverage works also really great on the way down, and exacerbating your losses. So, and we saw this in 2021 or 2022 in particular. A lot of retail investors, the market was down like 20% by the end of the year. A lot of retail investors were down 40, 45, 50% in that year because they had so much leverage inside of their portfolio. So again, the markets are great. And again, I can go to Vegas and I can get into a hot streak in Vegas, but eventually if I stay too long and don't take my chips off the table, house is going to win.
Yeah.
And that's the same thing for the markets today. So again, this is when we talk about risk management. We talk about, and again, to go to our article that's on the website today, talking about, the market yesterday, the tariffs. I've got some rules at the bottom of just small steps. Manage your portfolio with small steps. Don't make these big rash decisions all at once. Don't make big swings in one direction or the other. Small steps. Take profits, rebalance risk, portfolio allocation, sizing. All those type of things will help you just mitigate volatility, as things go along. And again, diversification, I can't just, we can go back over the last 2 weeks in particular, we've talked a lot about diversification because last Monday when the markets were down, almost 1.5%, our portfolio was down about 14 basis points. So it was down 0.14% versus the market being down 1.5%. That was due to diversification. Yesterday, our portfolios were actually positive and the market was down because of diversification. And, it was interesting yesterday that we saw companies actually doing okay in the markets despite this concern about trade wars. They were selected companies that didn't have a lot of exposure to Mexico or Mexico or Canada. But, there were companies that were doing okay. So diversification in your portfolio is very important to help you mitigate this volatility as you kind of go along.
I agree. It's a lot of questions too, as of late, as you can imagine, around bonds, interest rates being higher, bond prices maybe pulling back a little bit. Again, maybe they're on sale. But for the longest time, folks didn't want bonds in the portfolio. But then you have some bouts of volatility like this in the market, and bonds did well because you were seeing some rotation out of equities, kind of a risk off. Where was the money flowing? Is flowing over to the bond side. So like on the day of deep seek, bonds did very well that day. Earlier this week, bonds did okay. So so there is a reason why we still like having some bond exposure in the portfolio, because if there's a risk off environment from equities, the money might flow over to the bond side. So it all goes back into that balanced approach, right? But it doesn't mean that bonds can be fun to own all the time, or stocks can be fun to own all the time. So that's why you kind of blend these two different worlds together.
Absolutely. So a couple of things just as we get ready to kind of wrap up the show. Today we have, so a couple of things. Yesterday, everybody was all excited about the ISM manufacturing report because it pumped back up into expansion territory. It's been in contraction for a long time now. Finally showed a move back into expansion, something that we talked about before, that post the election of Trump, there's been a big surge in sentiment. This is actually last Friday's article on the website as well, talking about the return of bullish exuberance to companies, small businesses. The NFIB Small Business Optimism Index has absolutely shot through the roof, back to basically near all-time highs in terms of optimism. no real the business hasn't increased. There's not been a huge surge in business into those companies, but they're very optimistic that what Trump's doing for the economy is going to turn out well for them. CEO confidence has had a big uptick since the election. They're very confident that the things that the deregulation, potentially lower taxes, those type of things from the Trump administration will be very favorable to their business. ISM manufacturing surveys are surveys. How do you feel about things? Are you seeing an uptick in potential orders, those type of things? It's all a sentiment-based survey. So again, since the election, we've seen a big jump in that sentiment for manufacturing companies, services companies. We'll see that today as well. So we're going to, this is all sentiment. So in order for sentiment to stick, we have to see the translation of sentiment into actual action. So in other words, we need to see the consumers continue to step up. All of a sudden, these new orders come pouring in. People are demanding a lot more goods and services. We have seen some recent activity, end of December, early January, of companies kind of stocking up on inventory ahead of these tariffs, potential tariffs. So again, they've already got the inventory. So we may see a bit of a slowdown in some of this data over the next couple of months. So again, try to keep some of this stuff balanced. Today we have Alphabet, Google as out today. AMD, Amgen, Chipotle Mexican Group, Ferrari, Juniper Networks, Merck, PayPal, Pepsi, Pfizer. So big day of earnings. Spotify out this morning, beating earnings. Stock's going to be up a good bit this morning as well in that news. We'll be back tomorrow. We'll clean it all up for you, tell you where we are, and go on from there. So have a great day. Get by the website, get our latest article. It's on the website now about the trade war. It's on the website now, realinvestmentadvice.com. See you tomorrow.